Okay. Well, let's now welcome on the show Mr. PV Subramanyam of Subramani.com to talk about the last 1 year. Yes, I'm going to sort of put on the rear view mirror and look at this last 1 year. It's been quite an eventful one, even though we were all locked up at homes. But in general, there was so much happening around us, so much disruption to the way we used to live our lives. And perhaps in many ways, the things that we took for granted as well, was something that started becoming extremely valuable. But I think financially, we've taken quite a hit. Whether it's in terms of disruption to our businesses, whether it's in the form of, a pay cut or even an outright job loss. So what exactly are the lessons we've learned in this last 1 year, and how do we ensure that we are taking away, valuable lessons from all of these mistakes we may have made and implementing them? Mr. Subramanyam, good evening, and thank you so much for taking out time. So to start with, what were the most commonly asked questions by your clients in the last 1 year, keeping in mind, the way the markets moved, keeping in mind, of course, that many of them may also have been subjected to vast cuts in their income?
Well, luckily, I don't deal with too many people except readers of my blog and people who watch my videos. So yeah, there were such questions. But largely, if you see, the upper class or the upper middle class did not really get affected much. The lower end people, the carpenters, the masons, they are the people who got impacted real bad. The priests of temples, the dogs on the road who did not get food from the hotels, right? These are the real people who got impacted. The animals got impacted much more than the middle class and upper middle class. Yes, middle class learned one thing, that they could live without eating out. They could live without watching a movie, and they could live without traveling. So which means all these people who are spending 40,000-50,000 a month suddenly were spending 8,000-9,000 a month, right? So if you look at their credit cards, they all went on a huge diet. They just didn't spend money. Yes, there was insecurity. Some people were losing jobs, but amazingly, a lot of people got the freedom to work from anywhere. So people working in big cities just went off to their hometowns. Those things happened. But close to me, my level of people who got impacted, not too many. But yes, I got a lot of queries asking, should I stop my SIP? What should I do? So there the advice was very simple. You have to pay your term insurance. You have to continue your SIP if you can. However, if you have a cash flow crisis, don't continue your SIP. But other than that, not too many people really impacted too badly.
Well, mercifully. But yeah, I think the takeaway was, and looking at the way the markets as well moved, if you had not paused your SIP or redeemed your funds, you would have obviously benefited many folds. If you look at the kind of wealth creation by the markets and then concomitantly by mutual funds as well in this last 1 year, it has been manifold. So I think that was crucial. So in general, what were the lessons we have learned, Mr. Subramanyam, in this last 1 year, seeing all that has happened around us?
Okay, let's learn one important lesson is we will never learn from history. That learning will continue. For example, 2008, 2009 and 2019, 2020, two things happened which may not have happened. The recovery was very quick. The index in March 2020 was at 27,000. I'm talking of the Sensex, and today it is at so it had crossed 52,000 in February. The recovery may not be that quick next time. So when the market goes down, again, you have to ask the basic question, do I have the ability to stay on in equity? That question you should have asked in February 2020 or rather March 2020 also. If you couldn't stay for whatever reasons, you wanted the money in September, you should have removed. The lesson that we are saying we learned is in retrospect. In retrospect, we know that 27 came to 52, but the chances are 27 could have remained at 27 till now. And if you needed money, you had to sell, right? So the basic question doesn't change. Do you have money for 10 years? Then it goes into equity. If you have money for 2 years, it doesn't matter. You have to remove money from equity. You can't say, I didn't remove and then it went up and therefore I benefited. That's luck, right? And that is hindsight. So please be careful. What proved good was if you had cash, it was good. However, if you sold cash, if you sold to raise cash, that was bad because after that the market recovered. Another very important lesson is the role of gold in your portfolio. See, in March 2020, suppose you needed cash, the best thing to sell was gold. Not your debt, not your equity, because everything else, I mean, the debt, which was not the topmost quality debt, suddenly got into a lockdown. For example, if you had money in ultra short bond fund of Franklin Templeton, it just went into a lock-in. It got locked in for a year. Equity was bad. If you had mid cap and small cap, it was a disaster. But if you had sold gold, you would have been very happy. That is the role of gold. So don't look for returns on gold. Don't look for returns on savings bank. They are there for an emergency. Exactly when you don't feel like selling your debt and don't feel like selling your equity, it's one class which will do well. That is your savings bank account and your gold. That is also an important lesson to learn. And you also have to learn that poor quality debt which you have, or rather not top class debt, behaves like equity during bad times. So if you had lower quality debt, that behaved badly. But if you had top quality debt, if you had gilt and AAA, that did perform well. So in debt also, quality does matter. This was another important learning for us.
Oh yeah, absolutely. I think in general, in the way you curate your portfolio as well, it's something that you must keep in mind the kind of factors we went through in this last 1 year as well, which sort of moved the different parts of your portfolio in a different manner. I think a standard example was gold as well, on the way gold moved versus the way equities moved. Now, the other point was, Mr. Subramanyam, that we saw job losses, we saw pay cuts. These were there across all industries, regardless of, even if you were in the strongest industry. It's only now, that companies like a TCS, some of the other Tata groups have started giving pay hikes, which is great news. But still, there are many industries still yet suffering: aviation, tourism, the hotel industry as well, to a certain extent. So what was the best way to cope with that? And also, like you mentioned, right, this is neither the first nor the last crisis. How can we sort of prep ourselves from now for the possibility of any crisis in the future?
See, very many people talk about asset allocation and risk reduction. I think one important lesson is, if there is a couple, husband and wife, better not be connected and better not be in the same industry, right? Imagine if both husband and wife were working in Jet Airways. And that's it, right? That is the end of it. You both did not get their salaries. And this is very common, especially in airline industry and in the advertising industry. Both husband and wife work in the same company or an absolutely similar thing. I think your risk reduction starts from there. If one person is working in the bank and the other person is in the hotel industry or something like that, there is diversification there itself. I'm assuming both of them are earning equally, both of them earning 10 lakhs or both of them earning 20 lakhs. This kind of risk reduction also helps. Having 8-9 months expenses in the bank, which is something which many of us may not have suggested earlier, again makes sense. So having very good quality debt makes sense, because that will be liquid whenever you want. Equity will continue to behave like this, so it helps to sit calmly when equity goes through such a crisis. But remember, when I tell you this, it's because of 30-40 years of experience. We have seen equity do all this. But for a newcomer, the very important lesson is to write down what happened now and said, okay, by sitting tight, they benefited. Whereas a person who reacted in panic lost. Like you said, if you had not stopped your SIP, you would have done very well. But did you have the cash flow for your SIP? At that stage, to be able to prioritize and say, okay, my term insurance premium is more important than my equity SIP. Of course, my equity SIP would have done very well, but that is only if I had cash. Mubina, if I did not have cash, how can I have done an SIP, right? So that didn't matter. Dramatic drops and changes will happen. If you can't sit tight, then equity is not the best place for you. Or put a small amount in equity, which you say, come what may, my SIP will continue. I'll be able to afford that. Maybe I can afford 30,000, but there'll be a 3,000 rupee SIP, which I will never touch. And that will be a very good learning for you to see. But otherwise, people will get panicky. People will get scared. It is important to increase your health insurance generally. Don't go and take a cancer insurance, because if you have liver failure, the cancer insurance will not pay. So have a general insurance, which is big, have a top-up insurance, and have a super top-up insurance. Those things help. Those things will kick in because nobody thought that COVID will send 25, 30 lakh rupee bills, and that is what happened. That hurt people as much as the COVID crisis. Many people have rethought about their retirement, saying, if I have to stay at home and I don't know anything to do, what will I do during retirement? Because it is 30, 40 years, 1 year of sitting at home and people have just gone mad. So I do think many people who are talking of an early retirement have now withdrawn and they have no chance that they don't want an early retirement. So reconsider, find your hobbies. Don't find expensive hobbies, but find your hobbies, do something useful. And you learned that you can live with much less than what you thought you needed. You learned all those things. So take all those learnings home. Make sure you sit as a family and consider what is absolutely essential and what is a luxury. Make those lessons permanent by keeping it in writing and talking about it again and again. That's the only way you will reinforce and take it forward to your future life.
All right, okay. Well, you know what, Mr. Subramanyam, we'll just have to take a very short break. But ladies and gentlemen, we'll be back and we will be addressing your questions and queries. So all of you stay on with us. We'll be back after this very short break. Watching The Money Show on ET Now. Well, it's time for your questions and queries. Ladies and gentlemen, if you'd like to ask Mr. PV Subramanyam anything, you can email us. Our email address is themoneyshow@etnow.tv. Well, let's take on board our first question. We have Jay Pell who writes into us saying, what are the pros and cons of choosing an index fund versus an indexed based ETF? Okay, this is an interesting one. Mr. Subramanyam, which one do you think could be better? Which one is suited for what category of people according to you?
If you already have a demat account and if you are dealing in equity shares, etc., then an ETF makes more sense. Makes sense at all because you are active and you know how to buy and how to sell and things like that. But the ETFs are not always very liquid. So some days when you want to buy, you may not be able to get it. So that is one problem. However, in an index fund, you will be able to do an SIP. So you can do an SIP on the 5th of every month or on the 22nd of every month, whatever date suits you. And whichever day it goes down, you can go and add more. Whereas in an ETF, you have to be alert that on the 5th of every month, you have to remember to buy it. Of course, you can set yourself a reminder and all those things are possible. An ETF is likely to be a little cheaper than an index fund. So that is the only difference. But other than that, if you really don't know the difference, don't bother too much. An index fund is as good. However, if you're not a person who deals in shares, etc., and you don't have a demat account, then the whole cost goes up because the cost of having a demat account, demat charges, etc., especially if you go to a bank demat, those costs go up. Whereas in an index fund, you don't have any of those problems. And an index fund always gives you better liquidity. You will be able to liquidate within 2-3 days. Whereas in some of the index funds, the liquidity may not be very high. So it may take you a longer time to liquidate. But otherwise, both look very similar. So it doesn't matter too much even in the long run.
Okay. All right. Let's take on board our next question. SB Sivakumar writes in saying, please tell us about the following funds. The Tata Digital India, Axis Long Term, Mirae Asset Tax Saver. He's been investing in these funds through an SIP. Should I stay put or exit? So I think he is investing in it for wealth creation, for the long term. Anything on these three funds? Do you think he must be, he should perhaps increase the number of funds as well?
No, I think these funds are good. Tata Digital, what I don't like is there too many fund manager changes keep happening. But at this point in time, if you look at it, it would be a rockstar fund because technology is all done well last 1 year. But what I don't like about this fund is the cost is not very low. Second, it has no exposure to the FANG, right? Nothing in the US. I would like him to reduce it here and put a little money in some US technology fund also, at least ride that in a small way. If he's doing 5,000 rupees or 10,000 rupees SIP here, 2,000-3,000 rupees, you also please participate in the US technology because that may not do so well immediately because it has had a rockstar kind of a performance in the past. But at least you get exposure to those companies which are doing very well so some exposure there. here he can reduce exposure a little bit and increase his exposure there, or look for a fund which is investing in Indian technology as well as investing a little money in US or other countries, because the startup technology is not being captured at all when you invest in India. So you have startups in, say, Japan or Hong Kong or Korea or Taiwan or US, that is not being captured at all in India. So some exposure to some foreign funds which take exposure to these funds would be a little better. But otherwise, it's not a bad fund at all. But fund managers have been changing very often. That's the only worry.
All right. Okay. Well, I think that's all the time we have to answer questions. Mr. Subramanyam, thank you so much for taking our time and joining us today on the show. And with that, we'll take a very short break. Be right back with more.